Appreciate your patience, everyone. I think we can kick off, given it's being recorded. Everybody else will get a chance to pick it up. So let's jump straight in. We'll let others can come as they go. So again, a reminder: we're recording today's session. It'll be posted on our website under our Investor Hub, and you'll be able to, if you go into that, you'll be able to follow the recording. And if you have any other additional questions that I'm not able to cover today, please just put them in. You'll see from some of the last presentations, I do make those public and make sure that response is available to everybody. Okay, so let's kick off. Welcome to Wrkr's 2023 full year results presentation. Myself, Trent Lund, the CEO of Wrkr, and Karen Gilmour, our CFO, will both take you through this presentation. And bear with me. What we'd like to do is just quickly go through the highlights from my perspective. Karen's going to take you through a level of depth of our financial results. I know we covered a lot in our quarterly. It's one of the challenges of being a business our size. We do publish a lot of information to you. We've tried to make sure that it's not repetitive as much as possible. But we will go through the financial results, and then we want to focus a little bit of time on what is the 2024 focus that we're in the middle of now, and try and share a bit of context. So as our investors, you understand things you read, what you see us do, what the context is behind that. So without further ado, we'll jump in. I am keeping an eye on the Q&A, and I will try and answer questions. I'll pick up as we go. But I'm hoping to get through the presentation rather quickly. It's not in depth. It's about 10 slides. We'll spend some time on the Q&A. I really encourage you, ask the questions. If I can't answer them, I'll tell you. But be open. We want you to be inquisitive as shareholders. So let's start with the highlights. I will say, firstly, I'm incredibly proud of the entire Wrkr team and what's been achieved this year. It's been a very, very strong performance across the board, and I'll just share a little bit of detail of why I'm excited and why I believe it really forms the basis for continued growth now, and in a similar trajectory to where we are. So, obviously, we delivered an improvement on the FY23 financial performance across the board. And from our perspective, that just shows continued strong focus on the fundamentals of the business. We are being cautious on our expenditure, making sure that we're spending in the right areas. We are focused on managing that cash burn, a 21% improvement on a cash burn run rate from FY22 to FY23, which is significant for a business, and we do believe it's certainly our duty to continue to manage that as we go forward. Revenue up $6.6 million is the revenue, which is 43% improvement on FY22. We're very excited by that. There's a couple of aspects to that revenue. We have interest rates coming back on, which is definitely beneficial to our business. But we've also, across our broad portfolio of product, we're getting a solid balanced income coming through, which we feel gives us a strong base and ensures that we're not linked to just one revenue stream. So from that perspective, very, very proud. I would say that's also on the back of, I know there'll be lots of questions. We are coming towards the end of our pursuit on our major contracts with Link, which really to continue to grow and have a 43% growth without that contract yet being concluded is a real sign of strength of the business, and actually it gives us a much healthier base to build upon into 2024. I mentioned the revenue diversity is paying off. It's worth noting, outside of interest, probably the strongest performer for that growth is our SMSF Hub product, again showing the ability to both produce and take to market a product very quickly, and then continue to see the growth of that product. Link, the progression of the Link MSA, in the context of all of the work that's gone on this year, it is worth pointing out that we've been able to pull a significant amount of progress forward. And I want to talk about that in a couple of aspects. One, revenue. So we've been able to bring revenue into the business this year from Link, and that revenue has been associated with doing detailed design work, which our belief is that shows how serious they are about the project and the long-term nature of the business that we're negotiating. So that progression of that Link contract, we are comfortable of where it is right now, where we definitely understand. I'm with my shareholders. We would love these to be 2-month turnaround projects, but there is a reality check for all of us here. Link and other administrators, when they look at our services, these are services that are designed for multi-year. They have to meet a very stringent set of requirements, from security all the way through to being future-proofed around the regulatory changes that are coming, and ensure that their customers, the major funds, have a really deep understanding and are well bought in to the strategy. So a lot of work goes in behind the scenes, and that has progressed obviously to the point where we feel it is coming now toward a close. But on top of that, pipeline has grown considerably. We have worked knowing that these larger deals take a lot longer than we would hope for. They're great when they land because they're also long duration deals. But we've invested fairly heavily in broadening out our pipeline and opportunities, particularly around work with payrolls, with payroll system integrators, and HRM platforms associated with the payroll process. So that has been a heavy focus of this year, and that will drive into our FY24 priorities as well. And finally, continuous innovation. This year, in the backdrop of ensuring we're delivering financial results, being very cautious with our expenditure so we manage our cash burn, we've been able to still make decisions around bringing forward appropriate investments in our technology to continue to position the business forward. A couple of those which are really worth talking about. Delivering our onboarding and our super functionality, onboarding to super. That is now live in the market. That is live in Beam as one of the marquee platforms in the super industry, owned by ART, Australian Retirement Trust. And those enhancements, that has been a great opportunity for us to not only take our technology that we've delivered directly into the market to customers, but deliver it at substantive scale right within the complexity of the Beam infrastructure. So much more to come there. The team have been working very, very diligently to bring that to market last year, and we will see that strike quite an amount of interest across the other super funds as well, as they see results from that in production. Importantly, that functionality ensures that we've gone through all of the testing, not just the product, but the testing of the product and its relevance within the regulatory framework of stapling and super choice. The second big investment that we made and were able to bring forward, and very much off the back of interest rates being in our favour, some additional revenues, we made the decision to move our platform into a multi-cloud, multi-jurisdiction infrastructure. There are a couple of reasons for that. On the internal side, that improves our security dramatically. It means every engineer in our business has access only to the deployment of their code set and no access to production environment. So from a security standpoint, that is a real leap forward compared to many peers in the market. Secondly, though, it means that we are not restricted from the choice of cloud vendor or the geography that we move into. And we made that call specifically, as you will have seen. We've started early design work looking at the market into Hong Kong off the back of Link's success in that market. So we are now well geared to be able to take our core platform and any investments made in Australia and take those into any of the other markets from Hong Kong through to UK, for example. Third, there were a variety of releases of functionality this year around Wrkr Ready, which is our onboarding capability. These don't get picked up. They're often not big enough to talk about or make any specific announcement, but let me just run through a couple of those. Firstly, an integration to APRA, so not APRA, the regulator, but APRA, the Australian Health and Licensing regulator. And what that means is our onboarding isn't just onboarding and checking someone's medical license, but we are now able to help any business in the medical field, from chemists to aged care to hospitals, meet the requirements of daily checks of APRA medical licensing. And that really is a great example of our platform not just being there for the moment of onboarding, but continuous compliance. Secondly, you would have seen us if you've seen our recent presentations, we've moved to ID Match, so full integration again to ID Match and all of the associated agreements, which is a government body, which again is a demonstration. I was asked a while ago on this, what is our preference for integrations, and that is to integrate direct to source, so straight to the government departments and agencies. That lowers our cost to serve, and it makes us a key player as a supplier to other vendors. The third thing I just want to point out is Workday. Workday is the fastest growing of the global HRM platforms for managing your workforce outside of the payroll calculation component. We have just completed full integrations into Workday to enable the onboarding of an employee from your tax declaration, your tax file, your identity checks, and through into your tax, into your super selection. So going through your stapling and super choice. That's significant because a great deal of the high end of the market leverage Workday. Obviously, we're doing that through a partner where I'll keep that confidential at this point, but suffice to say that those integrations are ahead of a pursuit directly into the market, targeting organisations around the above 20,000 employee categories. So just to give you an idea. So let me pause for a second so everyone takes that in the backdrop. So we've been able to grow and keep our costs well managed, grow the revenue, ensure that we've got revenue diversity and that we're continuing to think about FY24 and FY25 revenue, while still focusing on the progression of Link, which we acknowledge is a significant opportunity for the business, but not resting on those laurels, and have continuously innovated our product portfolio within those budget constraints. So really, from my perspective, what that doesn't, it should tell you, but I'll make the words plain. There is a team of people that are working incredibly diligently on behalf of our business to achieve those results. So that's the highlights from my perspective for the business. A lot there for you to take in, but I want you to have as much insight as possible. And now I'll hand to Karen to run you through the financials, and then we'll move into the market, the look ahead for the market.
Thanks, Trent. Yeah, and I think Trent's touched on some of this already, but I think it's important to re-highlight our financial performance this year. As you can see, just from the screen there in front of you, we've seen a lot of improvement across a lot of different metrics in the financial year compared to last year. The Wrkr team really did do an incredible job of working incredibly hard throughout the year, investing in the product, the platform development, and achieving the revenue growth, as Trent has mentioned. That 43% of revenue growth, despite the Link deal kind of progressing as quickly as we'd like, just really shows that, you know, the business was able to deliver on what they had forecast for the year. In terms of the cost to income ratio, we saw that improve by 20%. And we ensured that those costs are managed closely with the requirements on delivering the revenue targets, making sure that our resources were invested into the right places within the business. That also resulted in seeing an improvement in our operating cash burn of the business. And that's really good to see that we're creating those efficiencies within the business, and we'll continue to look to do that into FY24. We also saw an increase in our annual recurring revenue. So to Trent's point around revenue diversity, maintaining contracts, finding other opportunities in our pipeline, you know, we saw that increase by 16%. So coming into next year, that's a really good position. We saw some of that was really driven by the success of the SMSF hub, which I'll touch on a little bit later. But we did also see, you know, the increase in our platform revenues that are recurring in terms of increases in licensing fees and support and maintenance as well. This year into FY24 and FY25, we do want to see the continuation of an increase in our annual recurring revenue as we aim to move out of that kind of development and planning phase into that more implementation and service delivery phase over the next couple of years. So management continued to carefully manage and balance its working capital to invest in the areas it needed to deliver this year. And that's really to set ourselves up for the opportunity for continued growth and the ability to scale our operations as we move into the rest of FY24. Pop on to the next slide in a little bit more detail on our statement of profit and loss. Thanks, Trent. So I've already touched on the revenues, but just in a little bit more detail, the increase in interest rates did see a return to our float income. So we saw some growth in the revenues due to that, which is great. We haven't kind of seen that for a couple of years. So it's good to see those return and enable us to use that money to make sure that we are investing in that future growth of the business and getting those revenues in sooner rather than later. The SMSF hub continues to be a success. We saw, you know, we've had the first year of full revenues from that since we launched in financial year 2022, but we saw an increase of $500,000 there, and that, you know, we did $610,000 of revenue in FY23, and we see minimal churn in that product. Well, you know, so there's lots of new SMSFs coming on. People do need to have their ESAs now, and so we're seeing kind of consistent holding in that, especially through our intermediary accounts that are bringing on more SMSFs every day. So we look forward to that continuing into FY24. And some small increases, as I mentioned already, on the platform license and usage fees. Although we saw the costs, operating expenses increase, we did see that improvement in the cost to income ratio. So we are still managing that very closely to make sure that we're achieving efficiencies and continuing to bring that cost to income ratio down. The key costs that we increased in the year were really about human resources and talent within the business, recognizing the areas that we needed to invest in for success. So we brought in a head of product, a head of customer success, and some more engineering, software engineering skills. And so that has been a great addition to the business this year. The other costs were from continuing our investment in our cyber posture of the business, and developing our Wrkr platform, as Trent mentioned before, to enable that multi-cloud and multi-jurisdiction capability. Okay, we might jump on to the balance sheet, into the statement of financial position. I won't spend too much time here. I just really wanted to touch on, we've seen our cash balance, grow significantly, increase significantly from last year. That was because we did a capital raise, and that was via two vehicles. So one was through issuing convertible notes of 3.3 million, and the other one through a share purchase plan that raised us another 942,000. So that has been a great outcome for the business, to allow us to really sit back and strategically think about where is the best investment in our business to move forward and to bring on revenues in, sooner rather than later, and to make sure that we're addressing the compliance needs correctly in the market as regulations change and as industries require more compliance for their employees. So yeah, that's really all I wanted to kind of touch on there, on the financial position, but happy to take more questions if anyone has any. And then just wanted to take a quick look back over the last few years, just to kind of show that growth rate and to show the great things that the business has been doing. Since the merger in 2021, we've had the rebrand, we've introduced new products and the onboarding Wrkr Ready product. As Trent mentioned earlier, we've also had, the additional Wrkr Ready functionalities around enabling for franchises, contractors, and that the administration of those coming on and off books, and the APRA capability, as well as your usual things, ID check, verifications. So, we've really seen the business change, diversify, and grow. And so you can see there, we've had 3 consecutive years now of revenue growth. We're continuing to improve our cost to income ratio and our cash burn. And I'm really excited for FY24 and the strategy that we've put in place with the management team and the rest of the team to see that opportunity to continue that trajectory. So yeah, on that, I will pass back to Trent.
Right. Thank you, Karen.
Thank you.
And all right. So look, fantastic results. I'm sure you'll agree. Let me move gear a little bit here into so there are things that we've been working on, but we'll continue to work on and put extra focus on in FY24. We'll talk about it as the year unfolds, but I want all of our shareholders to have a good understanding of what we're investing in and why, and how we believe it will add to the value of the business. So firstly, I want to state very clearly around our continued financial performance. It is our number one focus for the business, really, is to continue to carefully manage our working capital, manage that cash burn rate. We are very focused on there are lots of things we can make investments around. If we had large, access to much larger funds, there are many acquisitions we could look at as a business. The reality is we have a focus on growing this business organically as fast as we can, so that we are not creating dilutionary events for our current shareholders who have been patient with the business as we've turned the business towards high growth. So that is an important goal, moving towards EBITDA positive, so achieving EBITDA positive in FY25. We had lengthy discussions. That was, we believe, feasible within FY24. However, in our current forecasts, there is still investment to be done to bring large customers on board and onto the platform. And typically what we see is that takes an investment first before the transaction revenues, which is a long tail set of revenues, can stay. So we think that is a sensible objective. And very much you'll see a continued focus of increasing our ARR. So that is our our annualized recurring revenue year on year. We've already had a significant uplift in that revenue. Typically we bring on services revenue ahead of, so such as the work we've done recently with Link, ahead of moving into our SaaS or platform-based licenses, which are multi-year recurring basis. So we intend to continue that growth. The regulatory changes, and this is a really important facet, so I'll kind of just explain this a little. We are working very hard to position Wrkr to thrive under the payday super reforms. For those who I'll just share a little on those reforms. So the government have mandated, as at July 1 of 2026, we will now align super contributions to be done at the same time as pay contributions. The government are trying to achieve a couple of other aspects within that, and that is improve the data quality of aligning and understanding members through encouraging better onboarding. That's a massive tick for our organisation because that is an area where we've invested well ahead of the curve. But the payday super reforms, industry estimates would suggest a nearly tripling in the amount of transactions. So from our perspective, that is a tripling in revenue associated with transactions to do with super contributions by aligning super, which is often done quarterly, and aligning that directly with pay. When I say we're really focused on that, obviously there is an opportunity to just capture that net increase, but hidden in that is a much bigger opportunity for our business, and that is the ability, only a certain few companies can currently process super on the SuperStream network as SuperStream gateways, while there are a variety of companies who process pay events. The sequencing of these two events together gives an opportunity for us to take on both the pay and the super contribution event at the same time, create a real efficiency for our customers. That's going to be critical for our business to not just grow by adding more super funds and more contribution flow. It actually positions us far more deeply into payroll and HR processes. Talk a little bit more about that in a minute. We will continue to innovate our platform to be ahead of that curve. And also our focus is very much being what we would say first responder to compliance changes or new hurdles between employer and employee. From a partner ecosystem perspective, I mentioned before that we've had some positive investment this year. I mentioned around our integration into Workday. This year we'll see us invest in those partnerships, put far more structure around them, particularly around the human resource information systems, the HRIS providers, as opposed to just payroll providers, and evolve our collaboration with system integrators and advisors who serve the large end. Large corporations in Australia typically take their advice from leading professional services providers. That should give you an inkling of where our attention has been going. The fourth area is around our cyber posture. We have been making investments in our infrastructure, but we've also been making investments and selecting the right partners to think about how we secure both on the transaction side. So I'll talk to maybe in the Q&A, I can touch on areas such as what we've been investigating around Hedera and the likes, but actually also looking at how we move towards very, very modern cyber standards around what is called passwordless security. So that is the ability to understand our customers, understand their behaviors, whether they are coming in from the same browser, same device, in the same pattern that we expect to see, and only challenge them or put hurdles in place if there is a change to those patterns. That level of approach is really the new frontier of improving cyber posture. And we believe that is going to advance us. The feedback we are getting right now from funds is that our attention in that space is ahead of where they are. And for a simple reason, we are a full technology company. We are only 40 people, where humans are where your biggest risks are typically. So we are able to invest very heavily around a technology-based approach, which will help our major super funds and payrolls that work with us, help them achieve their compliance. For example, CPS 234 is a prudential compliance. It's a bit like ISO standards, but for financial organizations. That our approach propels us into that space, and we are moving faster into that level compliance than what we've seen with at last feedback. There were a significant portion, more than half of the major funds were struggling to achieve that requirement. So that's an example of sort of the four main areas that you'll see us talk to and activate through the year, and what the background is. So that's the forward investment. I'd like to just take a minute and just show you what that means from the way we've structured our products and where we're moving, and then we can jump into the Q&A. I can see there's quite a few questions there already. So really, the vision that we're bringing to life, and that we've been talking about for a while, is the one-stop shop for compliance, from both onboarding through to paying your employee, and that continuous compliance. We've mentioned on quite a few of our calls, every one of the licenses we have, or the compliance standards that we meet, positions us to be able to deliver this full stack, if you like, of services. But what's unique here, and let me just bring some of it to life, our product portfolio and what we are deploying and what we've been putting into our forward contracts, so everything that you see coming to market from Wrkr in anything moving forward, basically has our full stack of services being provided. So that is, although we will work with super funds to provide super contributions and manage that flow, our integrated solution will also provide a mobile-based solution to enable employees of their employer customers to onboard themselves securely, to make their super stapling choice, and process them all the way through, again, securely with accurate data, and then provide that data into the appropriate HRIS or payroll system. That is what our infrastructure is designed to do. And what that means is, when we take our contributions and roll it out with a major super fund, we are putting in front of every one of their employer customers our full stack of products, from full pay to super, which is subsidized or paid for by the super fund, through to STP, single touch payroll reporting, and all of the onboarding. It gives us, if you like, a continuous market to on-sell and cross-sell to without the initial cost of sale. That is why, behind the scenes, it feels like there's long-term protracted contract negotiation. The reality is, to pull this off and bring it to life requires it to be fully aligned to regulations for the super funds, such as the SIS Act. It requires us to have the breadth and depth of products available, and requires us to be able to support those at very, very large scale. So we're talking about the active contribution level customers. So that is what Wrkr has been doing behind the scenes. We haven't been as open about how each of these connect. You will have seen an update in our website recently, and that's because, frankly, our competitors can do their own homework. We have invested to put ourselves into a different space and offer a very different type of service that we believe is what the market is seeking right now. So that's the background on our business and where we're going. I'm hoping that will just evoke some questions. So I could sit and talk to you for ages. It would take a lengthy demo, and I'm not going to do it to you. So why don't we jump in to some of the Q&A? Feel free to add more while you're there for us. But if I open up first, there was a question. Can I speak more on art, specifically Q Super members moving to the Wrkr platform, numbers and timeframes? So timeframes, I can't speak to at the moment. There is a large program of work in place, and respect confidentiality with art. But numbers broadly, we have a platform there right now that services a little over 1 million, or art are over 1 million. So the Beam platform sits underneath that. A competitor still provides the super contributions for Q Super. That's a legacy contract that was continued to buy time. We expect those customers to move over onto our platform. We feel there's been enough investment from art and ourselves on that forward innovation. And I think the best example of that is obviously art rolling out the onboarding capability in their branded Beam offering. So timeframes, look, I've stopped guessing at superannuation funds timeframes. They're never as quick as I would like them to be, or you would be as shareholders. So I want to set your expectations to, it will take, if it is this year, it would be at the very back end. I would be expecting the following year. We would typically see a large amount of work prior with art before that would come to fruition, and they're the projects that we can see on our radar right now, but there's work to be done to physically make that shift and across. So hopefully that gives you a sense. I can't give you timeframes. That's it's sensitive on that side, but yes, it's an organic growth of our business. When Link Group contract drops, how many members are you expecting to initially move onto the Wrkr platform? So, look, on the assumption that that it moves forward, I don't want to give anything on timing, and I want to be a little cautious here because we are at the very, it's been a long, lengthy period of design, contract detailing, service level agreements, and the like. So touch wood, I don't want to disclose too much there until it's appropriate. But I would say the way to focus on it is the customers that we will bring on for any super fund really are in twofold. First tranche is always what we would call active members. So they are members that they process contributions for. Typically, that's about half of their total member network. So if you've got 2 million members, you'll have about 1 million actives. Obviously, we have designed our contract and our price points to service the whole of, or be able to be taken in conjunction with Link to the whole of their customer base. Obviously, though, we will start with a large fund and some smaller funds is the intent, and we'll continue to work on that. But yeah, look, the number's large. The question is over what time frame. I set expectations. I would have said positive EBITDA in 24 if I felt we just had to flick a switch. The reality is there's a large change program required to bring each of those, transition them off existing technology and over onto our technology. And our technology provides a lot more value, and we want to take the time to make sure those customers get to explore that full value of single touch payroll and so on. Can't speak to average price per member, but what I would say is this: we definitely see the transactions. We've built it on a transaction basis, so we do expect to see a large gain on transaction volume when we move into Payday Super. We have not provided just transactions. Our package includes a range of services, including some of the mobile experience and the ability to offer single touch payroll and the like. So that's pretty comprehensive. I'll just jump to a couple of others because they were all in one. There's a question here, and I know you're reading ahead, so you can feel free to jump in on any, Karen, so they don't have to listen to my Queensland twang too much. So what's the real addressable market that we're talking to here? Look, that's a good question. How do I break it down? The reality is the way we look at the market, to be on our platform, you circa, it's $1 a user, and there's 24 million members out there, but lots of users for different reasons on our platform. So we're not constrained by that size. The reality of the market, the transaction market is tripling in FY26. That market is what we've been spending all of our energy to make sure we have the largest base that we possibly can. We average, if you think about it, you typically around about, traditionally, if you only did transactions, you'd be $3 to $5 for a super. You'd be around $5, $3 for single touch payroll, and about $5 per employee for pay, and then float or interest income sits on top of that. And then you have onboarding. Our onboarding prices range, but typically between $10 through to $22 for the onboarding, compliance, and integration to systems, all the way up to around about $100 per employee for continuous compliance. So the market that is addressable by our technology space is multiply those numbers by there's 17 million employees, 13.1 are full-time employees. So at a conservative level, there's 13.1 million employees that all require those base services. And that's what we're working towards. Our goal is to be chasing no less than half of that market. It will take us a few years to bring that on, and we continue to have that as a goal. And we do not think that goal is unachievable, given the investments and the focus we've taken. So I hope that helps. I'm leaving you to do your own maths, Steve. Another one is major platforms, Bavera, Iris, Link, seem to be going through resets, restructuring, preparing for growth, notwithstanding your deal. Platform agnostic. Yeah, I think so the question here is, of the large administration platforms, where given the time it's taken for us to work with Link, do you multiply that for each one of those discussions? I think the reality is there's a tipping point that's being achieved. There's a positive is all of those major players are going through a level of restructuring. They're focusing on their core and what they're good at, and they are looking for partners who are very good at what they do. And we believe that's us. The tipping point is really about, in this industry, it's super funds feeling the competition or the advancement and proof points of other super funds. So as you get super funds adopting technology like our onboarding, that becomes a tipping point, which makes it more of the norm for the other players. So we don't think that partnering with others, we're not restricted in our contracts, but we don't think that will be as lengthy. I think Link really, they have shouldered a pretty big burden for probably they do represent the largest amount of superannuation funds. So, everything that they are going through actually helps to set the standard, and that standard is very much around us and our services. So I hope that answers your question, Steve. And do you expect to add further heads in FY24, and in what areas? Yeah, that's a really good question. We really marginal as a percentage. We're probably short, a handful of people, and that's about as far as we would go in FY24, subject to the growth and uptake of services. So I am very much of the view you hire people as the demand is there, and we can see the revenue locked in for them. So the shift for our business will be more towards what I would call customer success staff. So they are staff that can help a mid-size organisation navigate taking on our whole services rather than just having our super contributions. But again, I'm not expecting that to be in FY24. We'd be looking to do that on the back of the implementation of current contracts, which wouldn't be till 25. Don't know if you've got, feel free to grab one, Karen. They're getting sick of my voice.
I think just to John's question about headcount, we have already just brought on a senior quality assurance person and a cyber analyst. So I think they are really key roles to actually get into the business and fill that gap. But yeah, as Trent said, we'll look to see as we lock down revenues what we do with the rest of the staff headcount this year. Do we expect an R&B rebate in FY24? Yes, we are definitely looking at doing an R&D claim, and we are just in talks with that with our CTO at the moment to determine exactly what that project is defined as, and that will then lead to a better understanding of quantum, which can't speak to just at this point. I think I'm going to take the next one. I think lunch before the AGM or after sounds like a great idea. We'll put that on the suggestion list.
I'll vote for beverage after, but I'll tell you what, if you need incentive to come along to the AGM, I'll have some Wrkr t-shirts there. So Glenn, do the federal government industrial relations reform in same work, same pay, provide opportunities? Yeah, really interesting. We don't talk about it a lot when we talk about onboarding and continuous compliance, but actually there's roughly 4 main drivers of underpayment and failure to meet Fair Works requirement in Australia. 25% of the issues are generally driven by incorrect onboarding. So that's that not correctly classifying an employee or having the employee agree to specific terms and have evidence that they've done that. That's something that we built in the early days into our platform. So definitely the government's approach and continued push in the industrial relations is actually quite good for us, and putting the pay into into a better or a more structured format. We obviously have strong relationship with PaidRight that works in that space. We do quite a lot of collaboration sessions to ensure that we're taking their insights and improving our core product as well. I hope that answers your question on same work, same pay from Fair Work. And does better aligning super with payroll also provide future opportunities? 100%. I think it's probably the biggest. It's not done yet. So meaning you can't just turn up and win that game. That is why we've made the investment. And that page I showed above, which really is our why we've sought to integrate our set of products. Payday Super means a small handful of SuperStream network providers are in a very good place to start to drive, and we will get more transactions. But with those more transactions, that will create a lot more reconciliation challenges for the super industry. So we are focused on, in our platform, designing it so real-time reconciliation answers and takes that pain away. So there's a clear offset for why they would pay more for super and why they would want the SuperStream network to remain as quite a critical component. That's really important for us. But yeah, if you're today, And just for those who haven't had to sit in payroll and do the job before, which many of us haven't, the poor payroll officer today goes into and works in their payroll system and processes pay. They move to a separate system to process data and do file uploads and reconcile themselves between the two systems to then do their super. That's okay when you only do super quarterly, but if you are doing super every time you process pay, it makes intuitive sense to bring the two of them together and have pay be a natural flow into super, which is a natural flow into single touch payroll. Why wouldn't you want the one console, the one provider, and have a closed loop visibility there and reconciliation? That's what we're banking on yes, we are growing in our core business, but we see that as a significant growth over and above as that strategy takes flight. Sounds strange to talk about it now for 2026, but that date is going to come around real fast. And so if businesses in our space don't already have a compelling solution, they are going to be left behind, in our view. I'll just see if there are other. Hugh, could the link float interest be a material amount for work once? Look, yeah, let me talk about that. So the question was if under the link deal, would the float income associated with link be substantive? Just to be really clear, we've designed a couple of things that are important. We've designed our business around and our income around being transaction heavy, because we know transactions stay always and float does come and go. So we've certainly opted for a solution which is far more around sustainable income, as is traditional for those major funds where they are paying the contributions. They take the float revenue relative to them. That said, that's usually about 2/3. So about 1/3 of the float does preside with the AFSL provider, which would be us. In our own direct customers, we are 100% of that float. However, the float number, so in reality, we will get a big uptick because it's a much bigger base that we're talking about, but we've engineered it so that we are opting for more transaction revenue than access to float income, because if interest rates shift, you have that turn off overnight. And we are seeing other examples in the market where their proportion of float to total revenue is far, far too high from our perspective. So good while you've got it. What I would say, though, is where we've opted to provide pay, so if we're providing super and super contributions and they're paid for by the superannuation fund, if we are doing pay, so employee pay, the full float presides with us because it's being processed over our AFSL, and we can all do the maths. But for basically, my estimate is around about $1.50 of float on average in Australia income per super contribution per annum. That moves to around about $12 to $13 for the full pay. So it's if we are chasing float income, full pay is actually far more lucrative for us anyway. I hope that answers the question. And I'm just seeing whether we've got any others aligning with payroll. Yes, I think we might have answered nearly all of them. Although let me go back to John. You gave me about 8 questions to kickstart, and I know I covered a few. Let me just double check. How exactly will the Wrkr? Okay, how exactly will Wrkr platform gain access to Australian businesses via super funds? Can you expand on this? So yeah, this is an important nuance to understand, is where we provide our platform and for contributions through super funds, we are providing it under outside of Beam, where we provide the software under license and we innovate with Beam, but they carry the burden of the AFSL and much of the other compliance work. In all of our forward contracts, obviously, it is a SaaS or platform-based approach. We use our AFSL, and that means in the onboarding of every client, so let's take the average large super fund will have anywhere from 100 to 300,000 employees in the employers, in the industry fund categories. Every one of those employers has to be onboarded, has to go through a process of director consents for payments, and the likes, for approval of payments and processing. So by us being the AFSL provider and us being the core platform provider, actually every one of these businesses becomes a customer of ours and has a direct relationship with Wrkr as well as with the fund. That's really important because for the fund, it allows the fund to provide in front of the employer a full raft of services, but not pay for any services that would make them fall outside of the SIS Act, which prevents them for paying for customers effectively, which means we're there well placed to provide those services, but we need to provide that at a direct fee and a direct fee from Wrkr. So I think there's a very clever question, because what you're unlocking there is exactly why we've gone to the lengths we've gone to on these contracts, and to move into a SaaS provision as opposed to just being a license and services provider, which is where our business originated from before merge with Impaytech. Hope that I answered that clearly enough for everyone. If you have other questions, feel free to pop it in. Have you identified, I'll just do one or two final ones. Have you identified any businesses that would be worthy of targeting first? If so, why those businesses? I'm assuming you mean to acquire. So I'll say, yeah, there's plenty businesses we look at and monitor very, very closely. But I take it very simple. Buy them or beat them. There's a choice, and it's a trade-off each time. We're too small right now to buy. Our market cap doesn't really allow us to do it cheaply. And frankly, a lot of those businesses, you would be buying customer base and a really ugly cost base that seems to be tracking about equal to revenue, which is not where we're headed. Our cost to revenue obviously changes dramatically is our view in the forward years. So we see them out there, but I'm fast approaching the view that actually we might become a technology supplier to them and let them worry about cost of sale and let them throw labour at some of the problems like reference checking and the likes, and we'll stay to our core knitting and do large volume transactions that are far more profitable. But yep, we watch them regularly. There are a few, maybe two or three that I keep an eye on, but frankly, we're too cheap, and I don't think it would be a good result for shareholders right now. So we watch, but we want to grow out these current contracts first. Final, I think there was a question, and this is probably more forward. I'm going to hold this off for another day, if that's okay. The question is, can you give any news regarding Script, Hedera, and a wallet on sort of members and employees? A short answer is, yeah, absolutely. That we've been architecting for that strategy. I don't want to go too much into the various suppliers because it's more than them, and we are also building some pretty core elements ourselves. But in essence, we definitely believe, and the super funds we think agree with us, is the opportunity is to have, if you want to drive engagement, telling someone once a quarter that their super was paid into their super account isn't enough. But when you onboard them and they hold their digital profile, when that digital profile has further use, when you can tell them every time they're paid and in what bank account and their super, and that is all fact checked because of the single touch payroll and so on, you start to create an engagement with the individual, and that is the wallet infrastructure. We're very clear on our approach to doing it. It's a timing consideration at the moment on when we give the team the green light to implement that design. And right now, I'm just being a little bit tough on our innovation side of anything that won't convert to dollars or doesn't have natural competition too soon. But we have a very clear plan once we choose to execute. Hope that helps. It's very hard. We really shouldn't do these where you're just typing questions because I can't see you or talk to you. There is, sorry, one more from Luke. Will the business just opt in to additional services like a subscription? Yeah, completely. So, sorry, you're back to really the page I have in my background here, which is the businesses will be in there. They will sign all the terms just to onboard, to have their contributions paid for by a super fund. They will get nudged digitally within the application, obviously. There will be marketing opportunities, but they will be they'll be introduced to those services. But like you can see right to the right-hand side of the page, they'll be very evident in front of them and very easy for them to just turn on and opt in. And it is for small businesses. It's an approval of an extension of your credit card or a swipe. It's a leveraging of your direct debit authority outside of that. So we see that as a very healthy platform in which to continue to grow beyond the big lumpy projects or contracts that we've take time to bed down. There you go. So that is wow, I think we've run to an end of the questions. We have.
Yep.
So there you go. So I think probably I'm conscious, wow, we've covered some time and a few of you, you've been very patient and stayed on the line. Can I ask any feedback? We're open. I know a lot gets discussed in plenty of forums, Hot Copper, others. I don't engage in that forum because I can't. I can only engage either through our investor hub or in this format, so it's open and available to all shareholders. We're transparent and very open. So if you have a question or you want to engage, if you come through that forum, we're really happy to share more about our business. We're very proud of it, but I'm also very excited about where it's heading. So hopefully you as investors share that same excitement, and hopefully over coming weeks we'll have other news to share. So with that, bid you all adieu, and again thank you for being interested in our business and being shareholders.
Thank you. Bye.
Thank you.